Hello, everyone. Thank you so much for coming and joining in the last panel of the day. I know you're probably all a bit tired and probably ready for the final debate of the day, so I appreciate you giving your time and attention. My name is Madeline Jenkins. I'm a journalist at Environmental Finance. It's a financial news service which also has a database for tracking green, social and sustainable bonds and loans that you may find useful if you're at this talk. Because as you can see, this is a panel on sustainability-linked products and instruments. So we aim to provide a thought-provoking and lively discussion as the last panel of the day, which you may all take something away from, whether you've just come across these instruments today or you are a bit of a veteran. This panel will be an hour and 15 minutes long, with about 20 minutes at the end for audience questions, so please do keep some in mind. I'm excited about this panel because as important as it is to have big discussions about far-reaching standards, the devil is so often in the detail, and we can't go anywhere without scrutinising the nuts and bolts, that is, the instruments we're using to finance the transition. Although we are looking at detail today, make no mistake, this market is huge, and despite a slightly slower start to 2022, it's still expected to leap forward in growth, with perhaps a more positive forecast from PwC in May, predicting that almost half of all bonds in Europe could be labelled green, social or sustainable by 2026. Just for context, sustainable bond issuance reached $3 trillion in total just this week, Environmental Finance reported. I'll stop speaking and I'll introduce our panelists now. So to my left, we have Maher Al-Haffar, the Chief Financial Officer at Cemex and a founding member of the CFO Coalition for the Sustainable Development Goals. Next to him, we have Robert Sawbridge, the Head of Responsible Investment at Insights Investments. To my right, we have Farnam Bidgoli, Managing Director and Head of ESG Solutions at HSBC, I've said that wrong, and José Reséndiz Garcia, Doctor of Philosophy candidate and Research Assistant at the Oxford Sustainable Finance Group at the University of Oxford. So to set the scene, I believe José has a 10-minute presentation on his latest research on loans and bonds. So I will give the floor to you, José, to enlighten you all with his findings.
Thank you. Well, thank you, Maddie. I'm going to present more or less the overview of the market, especially the loan market. So let's get started. So one of the most pressing issues we have discussed during this summit is how we can mobilize trillions of dollars to limit global warming and align the global financial system with environmental sustainability. So in this panel, we will address the development of a very recent product in the capital debt markets that has the objective to link financial incentives with the sustainability performance of corporations. So sustainability-linked financing products are considered part of the sustainable fixed income market, which has traditionally been dominated by the use of proceed products, such as green bonds. However, sustainability-linked financing product has two key differences. The first one is that they can be used for any corporate purpose. And the second defining feature is that these instrument terms are structured to incentivize the borrower to improve its performance against environmental, social, governance KPIs, key performance indicators. So in practice, this would typically mean that the loan pricing is directly linked to the borrower's sustainability performance, or in other words, the rise or decrease in coupon rates depends on the achievement of those targets. So since sustainability-linked bonds remain a very small segment of the bond market, I will only examine in this presentation the sustainable loan market, where SLLs, or sustainability-linked loans, have dominated the market share since 2018. Even before the global loan associations published the principles that establish the foundations of such credit facilities structure. So today the market value of SLLs has surpassed $4 billion, and the red bars in the graph show the total value per quarter in dollars, and the red dots show the number of loans per quarter, and they show this rising pattern that I just mentioned. So who are the market players? Where do they come from? There are around 500 corporations representing different sectors such as infrastructure, food and beverage, resource transformation, transportation, and minerals, just to mention the most relevant ones. Also, most of these borrowers have issued loans in developed markets, according to the MSCI classification, which are the red circles in the second graph. However, most of their value chains are global, and very recently there has been a growing interest in emerging markets, such as Mexico. That's why we're inviting Cemex today, which is a very interesting case study. So it is now time to address two of the main critical challenges of this new asset class. So to develop a materiality score for the SLLs as part of my research project as a PhD, I have been testing a framework to assess the credibility and ambition of metrics and targets in SLLs. So ambition has been associated typically with materiality, with the concept of materiality, which could be defined as the factors that influence the enterprise value from an investor's perspective. And most recently, with alignment with a long-term strategy, such as climate transition plans. Many also advocate for a double materiality approach, considering the borrower's impact on the environment and society. Regarding credibility, disclosure standards are essential to preventing greenwashing in sustainable finance. However, a desirable condition for improving credibility in the SLLs will be the actual sustainability performance of borrowers, which cannot yet be evaluated properly due to the market's early stage. Also, I believe that even if we can confirm that borrowers are meeting their targets, we should still evaluate the relevance of such targets because they might be associated with non-material KPIs. So those familiar with the Sustainability Accounting Standards Board, SASB, may know their materiality map, which provides a baseline of material indicators of sustainability-related risk and opportunities for 77 industries. They divide 27 topics into 5 categories: environment, social capital, human capital, business model, innovation, and leadership and governance. This framework is important because the recently created International Sustainability Standards Board, ISSB, will build the new global sustainability-related disclosure standards on it. For example, in the construction materials industry, such as cement, SASB suggests that those areas highlighted with red have the potential to be material, financially material to the companies in the industry. And they also offer examples of industry-specific indicators. So keep in mind that their materiality concept only considers the investor's perspective. So based on the previous framework and the SASB materiality map, I have classified over 1,000 KPIs disclosed in the SLL market since 2017 to identify any changes in ambition and credibility before and after the release of the sustainability-linked loan principles by international loan associations in March 2019. The key takeaways from this high-level review are that the principles have no substantial impact on the disclosure or ambition of metrics and targets. Less than half of the KPIs are financially material, and over 30% do not reveal the exact metrics despite presumably following standards such as SASB, GRI, or the Science-Based Targets Initiative. Also, after reading dozens of multiple press releases, I can confirm that some borrowers provide the names of their external reviewers. However, more than 80% of borrowers do not provide this information. Most market players that report material KPIs do not specify a target. And in other cases, they admit that they do not have one at the time of the issuance, but promise to have one in the future. Less than one-third of KPIs are linked with the borrower's sustainability strategy. However, more than half of the greenhouse gas emission targets are connected to a net zero corporate commitment. So the first graph in these slides shows how the selection of financial material KPIs has not matched up the market growth. I have excluded the use of ESG scores, which accounts only 15% of all KPIs used in the market, and its use has been declining over time. Moreover, the second graph represents the disparity between material and non-material KPIs in the most significant industries. When selecting ambitious KPIs, for example, we can see in the infrastructure sector, showed forth on that effort. Some consider sustainability. At the beginning, we were thinking to title this session as Transition Finance, since some consider sustainability-linked financing products to be a transition financing vehicle. However, I believe we are still a long way from that expectation, since most of these instruments are still not aligned with a transformation model, with a transformation of the business models towards a net zero and sustainable economy. In this diagram, for example, I'm integrating over 3,000 KPIs from the sustainability reports of the borrowers in the market, from the most relevant sectors mentioned before. So most KPIs fall under the SASB topics of greenhouse gas emissions, energy, water, and waste. However, only 30% of those KPIs, the majority of which are connected to emissions and energy, have been included in SLLs. This situation reveals at least two things. The first one is that there is a huge opportunity to include a broader range of environmental-related KPIs that borrowers are currently using and integrating in their strategies. Second, capital providers may request that the borrowers' short-term goals may be connected with long-term strategies, such as climate transition plans. To conclude, here are some provisional principles I have been discussing with colleagues at the university. The principles for transition-aligned metrics and targets will have the objective to integrate these instruments into long-term transition pathways of borrowers. And here are some examples. So metrics and targets should be aligned with interim targets of capital providers and counterparties' transition plans. Metrics and targets should integrate a double materiality approach, which will be possible with the coming global standards of ISSB. Metrics and targets should be included in the issuer's annual reports. This will be convenient since those reports are audited. And in the end, we are expecting to see more and more financial material KPIs. And finally, third-party verification outputs should be included in the issuer's annual sustainability reports. And that's everything from my side. Thank you.
Thank you so much, Jose. That was really interesting, as you could probably see from the way we were craning our necks to see. First of all, I'd just like to follow up and quickly ask, what was the most striking thing that you found from your research? What kind of struck out to you the most as being, that's very interesting. For me, it was perhaps maybe that the principles don't impact the disclosure of KPIs.
Yeah, I mean, for the purpose of this presentation, that was one of the most striking findings. This is just the initial part of my research. I mean, I'm trying to build a materiality score for SLLs and SLBs that I'm planning to publish by the end of the year.
Great. Well, if you have any questions for Jose, we will be answering them at the end. So keep them in mind, take a note of them, whatever you need to do. But now I'm going to try and open the panel up for discussion. So Jose just presented some findings there on sustainability-linked financing, but I think it might be good to sort of set the scene for what has been happening in this market over the last 6 months, over the last year. So I'm just going to ask all our panelists, what has been happening in the sustainability-linked financing landscape in 2022? It seems like liquidity may be slowing compared to last year. Why do you think this is? And what have you noticed in particular? Maybe I can pick on Farnam first of all, as our structure.
Yeah, absolutely. I mean, I think, look, the market is obviously not immune to what's happening more broadly. So there has been a slowdown both on the bond side as well as on the loan side. But actually, when you look at it in the context of a total slowdown in debt issuance, actually we've continued to see growth in sustainability-linked and green bond issuance. And on the loan side, while the volumes are down, the number of issuers that are taking out loans has actually gone up. And then maybe more interestingly, the number that continues to increase is the percentage of sort of sustainable finance instruments as a total percentage of outstanding issuance. So that number today in European investment grade probably sits around kind of 20%. In sterling, it's actually a lot higher. It's closer to 40%. And even in the dollar market, which has been maybe a bit slower to take on sustainability-linked instruments, we've seen it rise up to about 9% across US investment grade this year. So, you know, there is a slowdown, but when you look under the hood, I think you're actually still seeing issuers very interested in coming in this format. And I think that is probably a response to the fact that regardless of whether you come in sustainability-linked or green issuance or conventional, you're going to get a lot of questions today from investors and from your banks on your ESG strategy. And so the format still remains quite useful for communicating that strategy.
Why do you think sustainability-linked financing is slightly higher in the UK and in sterling?
So again, it's more a reflection of the sector. So in the UK, we tend to get a lot of issuance from the housing associations, from property, which are sectors that have an easier time with both the use of proceeds format and increasingly also the sustainability-linked format.
Great, well, thanks for that first answer. Robert, same question to you. What have you seen happening in the landscape? Do you agree with Farnam? What do you see?
I would say I partially agree with Farnam in that certainly it's the case that the market slowed down a lot. Obviously, when there is volatility, there is just generally less issuance in the market. I think these instruments as well are sort of trying to find their place in the world from an investor perspective. And obviously a lot of buy-side asset managers such as ourselves are looking at the regulatory environment, and particularly with an eye on SFDR, Article 8 and Article 9. That regulation is moving very, very quickly, and interpretations of what it means is changing. And it's not completely obvious how these fit into that regulatory environment. So when you think about sustainable investments as a defined term under SFDR, whilst use of proceeds bonds, you can make a pretty strong argument, definitely fit into that. There are elements of sustainability-linked structures that leave some legal grey room, I think, as to whether they should or shouldn't be considered sustainable investments. And I do wonder, I mean, I don't know if Farnam's had that feedback from other investors, but that's certainly a big debate that we had quite recently. We've come to the conclusion that they aren't in and of themselves sustainable investments unless the underlying business has an economic activity that is considered to be sustainable.
Farnam, care to respond at all?
Yeah, it's interesting because I think last year there was a huge surge of interest in sustainability-linked instruments, and in execution we basically didn't see any difference between the investor reception to sustainability-linked and then the use of proceeds bonds, be they green or social or sustainable. There has been a slight uptick this year of more interest on the use of proceeds side rather than sustainability-linked, which I suspect is connected to Robert's point that especially as investors grapple with SFDR, is probably the best verb, they are more attuned to the utility of the reporting that they get on impact from a use of proceeds bond. But it's not huge. And I'll be honest, we get a lot of questions about where the greenium has gone in 2022. And it's true that it's really not nearly as visible, but in syndication, I think we would still say execution risk is a lot lower for any kind of sustainable finance instrument versus a conventional, just because of the investor appetite.
Okay, I'm going to put a pin in regulation and definitions for now. Try and come back to that. Maher, would you like to weigh in at all? Where's the greenium gone?
Sure. Well, we haven't issued any green bonds. What we have done is close to about $3.5 billion worth of sustainability-linked financings. And most of our investors are US-based, although we do have our fair share of European-based investors, both on the bond side and on the equity side. We're particularly large on the bond side as well in EM and non-investment grade. We're a BB+ rated company. What I can tell you is that I don't go into a single investor meeting anywhere in the world these days, particularly in the US, where we don't get significant questions about our ESG strategy and questions about, when are we going to bring to market more instruments that are somehow either sustainably linked or use of proceeds linked as well. I think, from what I see from the investor world is that probably in the next few years, 4 or 5 years from now, you won't have access to capital unless you come in this format, probably, or you're going to be paying through the nose for capital, whether it's debt or equity. And I think that it's going to be interesting to see how issuers react to it. And one of the things that I'm doing, at least, Cemex as a company and myself as the CFO of the company, have decided to be one of the founding members of the CFO Coalition, which is a UNGC auspices coalition. And what we're trying to do is actually educate companies all over the world about how to come to market, how to build roadmaps and meaningful roadmaps, and we can talk about it in the rest of the... But I see this as a trend that is not going to stop, and if we see a little bit of a slowdown, it's probably because of the volatility of the market, not because of a kind of backtracking on the instruments themselves.
You mentioned that you're getting quite a lot of questions at the minute. I'd just be interested to know what kind of questions are you getting about the next product you're going to be issuing?
From investors, you mean?
Yeah.
Yeah, I mean, it's interesting because, we started, it's funny, in the US, we had virtually no interest in ESG adherence until about maybe, 12 months ago. And then now, if you talk to virtually every large investor, they're building these gigantic ESG research groups in order to enforce what their ultimate investors are demanding from them, which is to invest in green instruments, whether equity or debt. And so a lot of these firms, the BlackRocks of the world, the Fidelities, I mean, I'm mentioning them just because that's what comes to my mind. They have engaged us very closely at a highly specialized level. We've had to put them in contact with our technical people because they're going to such high degree of diligence on our roadmap and pathways to make sure that what we're saying is ambitious enough, it's rigorous enough, and it's tested enough. And they meet with us on an annual basis, sometimes even more frequently. So that tells me that, with that kind of investment, that kind of time that is being put on the table, this is not going to go away. This is a serious thing that will continue to happen in our world.
Maher, you're getting a trick hat because that sort of leads into my next question. How do capital providers and their counterparties negotiate targets and key performance indicators, or KPIs?
That's a good question, and I think that certainly my two colleagues here should answer that as well. But when I think the notion of negotiation in this process is kind of a bit misleading. I think what issuers, this is what we did and what I advise other issuers to do, is to really kind of put their best foot forward and be ambitious in identifying what is the most important lever in their journey in climate action, whether it's decarbonization, whether it's a water issue, whether it's a circularity issue or whatever. In our case, carbon is very important, so we've identified that. I mean, cement is labeled as a hard-to-abate sector. We don't necessarily agree with that. We can address that in the Q&A session. But I think that certainly what we did is we took the most ambitious benchmark that exists, which is the well below 2-degree scenario. We, of course, we have been doing this for now close to a decade, and I would suggest that from that ambitious kind of curve, develop the most important KPIs that get you there. Make sure that these KPIs are rigorous, they're clear, they're auditable. And that you do all of the right things, and we can talk about that, whether it's developing frameworks or getting validation from credible counterparties like SBTI or whoever, and then come to the market. I think only if you do that, you're likely to get the recognition and maybe get value above and beyond fair value on your instruments at the end of the day.
Farnam, quite naturally going to the other side of things, how do you guys negotiate targets and KPIs?
So look, I think Maher's just described the gold standard of what should happen, right? It shouldn't start at all from the financing team. It should start from strategy, from business, from the sustainability team. They should be identifying the material impacts. They should be looking at the roadmap of what is achievable and setting out targets, and then communicating that through a framework that is sent to banks and investors in the case of a sustainability linked bond. I think we can differentiate here maybe between what is common practice on the bond side versus the loan side. So the reality is, I think on the bond side, there is a much higher degree of scrutiny. And so you see issuers that have come in the bond market, more often than not, kind of follow that standard of starting with the strategy. And that's because they can expect, and Robert will attest to this, I'm sure, in a minute, that when they come to market, there will be a very high degree of scrutiny on the targets that they have set. The loan market, I think we can probably be frank, and I'm a bank, so I'm probably the one to say it, does not have the same level of rigor. The loan market to date has, I think, functioned much more as a way of banks engaging their clients on a conversation around sustainability and understanding their sustainability strategy. But the KPIs within sustainability-linked loans are typically not nearly as rigorous as what you would expect to see in the bond market. And you can kind of tell that almost in the sense of how many issuers have done sustainability-linked loans versus who's done sustainability-linked bonds. I think, some of that is changing. I hear more and more from my peers that they're setting up governance councils internally to kind of vet sustainability-linked loans and subject issuers to that same level of scrutiny that they could expect to get in the bond market. But to date, I think a lot of issuers have come into the sustainability-linked loan market, and I think José's research kind of attests to this, with lighter targets, and it is more about the kind of symbolism of coming into a sustainability-linked loan rather than necessarily a highly ambitious target.
And Robert, what do you think?
I think from my perspective, I would just echo what the other two guys have said. The big thing is don't do a drive-by. So a drive-by in the market is when you just come at 9 o'clock in the morning and then print at 9:20 and there's no time to look at anything. That won't work. What you need to do really is look at best practice in the market, come with a well thought through program, do a bond roadshow so investors can scrutinize it and have conversations with management, and potentially, that there may be some wiggle room in terms of updating the characteristics if the investors don't like it. And generally, if it happens in that way, there's normally quite a constructive dialogue between issuers and investors, and you get a well oversubscribed book, potentially with a level of greenium, because the investors are very confident in your story. So that would be my advice on best practice.
Sorry, go ahead.
Maher, would you like to add any comments?
Yeah, I just wanted to follow up on something that Farnam mentioned. I mean, we definitely have seen softer approaches from the banks, but if there are any banks in the crowd, I was a few weeks ago on a round meeting our banks, and virtually all of our major banks, especially the European banks, because of their stewardship process, are now all signed up, or most of them are signed up for the net zero. I forget what it's called, net zero coalition or whatever, and the level of scrutiny is definitely increasing quite significantly, and I think that we're going to see the banks. They have trailed, but I think we're going to see them, definitely becoming much more, let's say, scrutinizing the terms that are being brought to market or the loans that they are participating in. In our case, I have to tell you that preemptively, we defined some very, very tight targets based on our, well below 2 degree scenario roadmap, which has been validated by SBTI, and we got also a second party opinion from Sustainalytics, which is not exactly an easy counterparty to convince to understand and validate your structure. And we've undertaken probably the most comprehensive set of KPIs. We adopted 3 KPIs that are critical and are important levers to our business. One is a very specific CO2 reduction target on an annual basis, and certainly by the maturity of the loan with specific. So we actually disclose annually to the banks our CO2 emission reduction behavior. We also committed to an alternative energy usage, which is a very important part of decarbonization, because when we take a look at our Scope 1 emissions, there are two very big elements. 80% of our Scope 1 emissions come from process and fuels. So committing to a reduction in fossil fuel usage was extremely important, and we report on that every year. And then clean electricity, because power is the most important Scope 2 consideration in our industry. So we also committed to an increase in clean power on an annual basis, on a very ambitious basis. So I think, we wanted to set the standard, frankly, and we were kind of positioning ourselves not just for the loan market when we did that in our sustainability linked structure, but we were also positioning ourselves for the bond market, and also to kind of send a message to our shareholders that we have a very rigorous roadmap, and we're putting our money where our mouth is at the end of the day.
Just to add to that, it's worth saying from our perspective that is the sort of best practice that we look for. So we have a rating system for all use of proceeds and sustainability linked products, which is basically dark green, light green, and red. And the Cemex program actually scores dark green, which puts it in the sort of top 20%. I checked that before I came today, just to make sure I had the details. But it's worth saying about 25% score red. So there's 25% of use of proceeds and sustainability linked structures that we don't think are particularly well thought through, and we wouldn't categorize as being impactful in terms of what they're trying to achieve. So that's just really evidence that investors like ourselves and others will be scrutinizing these characteristics.
Why is light green not yellow? Where's yellow?
So we originally had red, amber, green, but we will effectively say that we will buy amber or green, so light green or dark green, and investors were starting to question, why are you buying something that you've got some skepticism about? So it's just a sort of a marketing thing, really, but it's the same thing.
Well, I appreciate your honesty. Okay, it's good to kind of get into some of those details there, because I wanted to sort of talk about some more of those nuts and bolts. So what do you guys think are some of the pitfalls in current bond and loan structures? How would you like to see these improved to incentivize more sustainability? Maybe I can start with Robert.
Yeah, so I'm really coming at this more from a bond perspective. Insight is more of a investment grade and high yield bond house. We don't have a big loans business. But, as a result, if you think about this market, it's really grown. The first issuance was in 2019, which came from Enel. And I think it's fair to say that issuers, syndicates, and investors are still sort of grappling with what best practice looks like, as I alluded to at the start. We've certainly seen some experimentation over the last 3 years in terms of structures, etc. One thing that seems to have emerged as a relatively consistent point is that this concept of the coupon step if you don't meet your KPIs, and that seems to relatively consistently be 25 basis points when people come to market. I think, from our perspective, when we have dialogues internally, there's always been a view that 25 basis points is not enough to incentivize behavior. And if I give you an example, going back to Enel when it issued its first couple of bonds, and by the way, we really like Enel as an issuer. We think it's a very sustainable company. It's a good issuer, a leader in the space. But they issued a 2029 bond with a coupon, with a 25 bip coupon step. If they missed their target for that bond, it would cost them an extra 3 million euros a year in terms of interest costs. Their total interest costs in 2020 were 2 billion euros. So the concept that 25 basis points on a single bond is enough to incentivize behavior is just not correct in my view. The other thing to say is that for other step stepped-based characteristics. You get when you go from investment grade to high yield, there are often coupon steps built in. That would typically be 125 basis points. So that gives you some context that we don't really think the incentives are there unless the issuer builds out a full SLB curve, so turns all of its debt into SLBs, in which case cumulatively that might add up. And actually, to be fair to Enel, they have issued a lot of bonds. So I don't want to single them out because, as I said, they're a good company. The other bugbear for investors in terms of structures is, as we mentioned, setting targets that are unambitious and metrics which aren't relevant to the business. We briefly talked about this concept of setting a KPI that is linked to, for example, an MSCI rating. That's something we really don't like. We don't really see the relevance from a sustainability perspective. Generally, MSCI ratings are more about how companies manage their sustainability risks. They're not about sustainability impacts. So I think the market has some evolution to do, some maturity to do, but I think it's got a lot of potential as a market. And there's lots of elements of sustainability-linked bonds that actually are maybe more have a higher level of additionality in terms of achieving some of these goals than potentially use of proceeds bonds, which can involve a lot of refinancing of existing projects rather than sort of putting companies on a better forward trajectory.
I'm going to ask a cheeky question of Robert, but actually I'm stealing from Tessa, who asked this question this morning, which is, I completely agree, by the way. I think the 25 basis points is quite arbitrary, and even if you want to argue that it made sense for Enel, since then companies have come to market using 25 basis points with a wide range of credit profiles. So the kind of hanging on to 25 basis points is a bit strange. But the question that Tessa asked this morning is, why do we only see it in the loan market that we have a symmetrical structure of a step up and a step down? And why in the bond market today do we still get a lot of pushback from investors around potentially adopting a step down for, especially for those issuers like Maher who are doing very ambitious targets? Would you be able to reward that?
Yeah, it's a really good question. If you ask me what I think personally, I think there's a perfectly good rationale for a step down. If you think that these issuers are setting ambitious targets, that if they meet them, effectively we're saying their credit risk profile has improved, then you should be happy to fund them at a lower rate. But I think that there's two components. I think selling that to our end investors is hard. And I think that bonds are often used for fixed cash flow matching purposes. So insurance companies, liability-driven investments, they need to have surety of cash flow to be able to match their liabilities. And the idea that you might suddenly have a hole in terms of your cash flow doesn't appeal to a lot of those investors. So I think that's probably the reason, but I have some sympathy that philosophically it should be allowed.
Maya, would you like to add anything?
Sure. I've always, ever since this whole conversation started, not this conversation, but the conversation about, sustainably linked in financing came up, I always kind of, as an issuer, ask myself, okay, why shouldn't it be symmetrical? And certainly in the bank market, it is. And in fact, we would like to see, and certainly through our coalition, we would like to see that even if a bank or an investor gets a benefit from an issuer not performing under their commitments, under their KPIs, that whatever extra coupon or extra benefit that the investor or the bank gets, that money is invested in green investments, right? So at least have that level of symmetry. But in our view, there should be up and down symmetry. I do think that the market is growing. It's maturing. I agree with Robert that, and I also respect Enel. They're a very important player in the coalition. They chair the coalition, the CFO coalition that I'm part of, and part of that coalition, all of us, all the CFOs, all the founding CFOs are committing to at least have 50% of their debt stack sustainably linked by 2025, which Cemex has committed to do that. And we have gone one step further. We have also said that we're committed to get to 85% of our debt stack, which is the tightest percentage in the industry, in our industry, be sustainably linked by 2030. So we agree with you that yes, I mean, this whole thing cannot be looked at on an instrument by instrument basis. It should be throughout the whole debt stack. We're looking at our loans, we're looking at our bonds. We've just done close to $700 million worth of securitization transactions in multiple currencies that are sustainably linked. We've even done some derivatives in the market, close to $1 billion worth of derivatives that were sustainably linked. So in my view, I really do think that from an issuer side, we need to put our money where our mouth is. But I also think on the investor side, we need investors here, I'm saying banks and asset managers, we really need to have some more symmetry. We need to have some more, give and take, not just, it's only a penalty essentially, and there's not much of a benefit. And I think that will go farther. And I'm saying that not just because it's the right thing from a business perspective, but also, let's face it, I mean, climate action is also the right thing for society, for us and for our children and grandchildren. So I look at it both from an altruistic perspective as well as an economic perspective. And so I wish the investors behave accordingly as well.
I want to go back to something that Robert said earlier, because I won't lie, it slightly worried me when you said that the light green loans and bonds are essentially kind of the yellow category, essentially the amber category. Do you think that you sort of need to kind of make that clearer and kind of make it clearer around your definitions around sustainability? I've spoken to you a little bit before about how there needs to be clearer definitions around sustainability in general. So do you think regulation needs to come in and sort of make this clear, sort of allow, make it so that there isn't as much wiggle room allowed to sort of, package everything in slightly different ways, so we all have slightly different terms for things?
I think definitely it helps from a transparency perspective. We are quite transparent in terms of our reporting, so we will say what's in the portfolio, whether it's red, dark green, light green, and various other characteristics. But I think, particularly this market that is so new, and there's so much confusion around what an acceptable KPI is. I think a higher level of standardization would be helpful, and I think we are starting to see that. So ICMA came out, I think, as recently as was it June or July this year, but they've come out and said, look, here's 300 KPIs that we think are acceptable for different industries. So you're starting to see the maturity of this market, and I think it will come. And when it does, I think you'll start to see things settle down, as you have seen in the green bond market.
In the meantime, do you think maybe these kind of like light green bonds and loans should be maybe sort of branded as something a little bit clearer, maybe a transition bond or loan, or something a little bit more clear? So
light green, to be clear from our perspective, means that they fulfill some of the characteristics that we would expect in terms of best practice, but not all of them. So dark green is really where you've sort of ticked 90% of our boxes. Light green would be you've ticked 70%, and then red you've maybe ticked less than 50%. So it's not. It's more you're using the same framework, but it gives a different output, if that makes sense.
Okay. Farnam, what's your perspective on this? What's HSBC's approach? Do you have sort of like a traffic light kind of system in a similar way to incite investors, or do you think that this is kind of common market practice? What's your perspective on this?
Well, as a bank, as I said, we have a governance committee set up around sustainability-linked loans. So what we don't structure goes through that committee. That committee includes members of risk governance from the sustainability side, as well as the business. And we usually have a pretty healthy amount of debate with regards to all the loans that we are taking on. And as I said, there's been a number of cases that we have agreed to be part of a financing, but told the issuer, actually, we're not going to label this as a sustainability-linked loan for ourselves. We're coming into this as if it's a conventional financing and providing it to you on those terms. which is, usually a very difficult conversation to have with an issuer, because nobody comes to market sort of wanting to greenwash. Let's just be clear. Everyone comes to market with the best of intentions. But as I said, I think it's a shift between these instruments having a history maybe of being a tool for engagement between banks and their clients, versus now where we want to use them as a tool for looking at that transition risk. And as Maher rightly points out, I think all of the banks that have signed up to the Net Zero Banking Alliance and are thinking about how is our portfolio going to transition over the course of the next, let's say, 8 years, given we have 2030 targets, we'll be looking at the sustainability linked loan as potentially a tool to drive the change that we want to see. But that's new. That's a more recent change, and not every bank is necessarily there yet. So that's the conversation that we have as a bank when we are financing. I think when I'm structuring something, working alongside a client, as I said, I think there's a lot more by way I can point to in terms of, robust engagement with investors ahead of it coming to market. So we do a lot of just broader kind of fixed income credit engagement with our clients and investors, so that they can hear from investors like Robert about what they actually want to see in these instruments. And then I think Maher alluded to it, but the second party opinion process, if done correctly, is actually another way in which you can nudge ambition and ensure that you're getting robust targets, because the second party opinion providers should be really questioning not just the target itself, but the pathway for that target and what the kind of strategy is to put that target in place, which should end up with a robust outcome.
I know a lot of investors feel like their hands are slightly tied over fears of greenwashing, and I don't want to add to that. I don't want to pour fuel on the fire, but respectfully, I'd say that some people do come to market wanting to greenwash, as kind of evidence would suggest. I was going to ask, actually, anyway, do you think market growth is slowing due to doubts about greenwashing at all? What kind of common criticism are you hearing about specific loans? What examples of greenwashing have you seen yourselves? Maybe going back to Farnam.
Look, I think actually a good example was raised around the use of an ESG rating. And the reason that I think that's, it's a bit of a dodge is that it's not just that an ESG rating is it's a disclosure-based rating. It's not really telling you much about a change in performance, but also that, typically an ESG rating is 70 different indicators, and a lot of them now are also scaled according to performance across the sector. So, an issuer can see a change in their rating without anything actually changing on their side at all. And conversely, they can see a downgrade in their rating without anything changing on their side. So the fact that we still see a number of, in the loan side in particular, loans coming to market using an ESG rating as the indicator, I think is probably something that we at HSBC are quite adamant that needs to stop, and that we really push our clients to say that it's not the right approach. Otherwise, I think what you see is, I think José has touched on the materiality aspect quite well. It's not always in KPIs that are touching on the SASB indicators and the topics that are most material. We also see issues around scope, right? What actually falls into the scope of the SLL in terms of the issuer's business. Whether it addresses, for instance, if you are a financial institution, you should not just be coming to market with an SLL that addresses your own operations, because that's always going to be a tiny bit of what your impact is as a bank. So you need to have something that looks at your investments, your lending, and your portfolio.
It's really interesting you say that you'd sort of discourage the SDG kind of rating.
The ESG rating.
Sorry, I misheard you. Too many lights. What would you sort of suggest as an alternative?
So I think José laid it out well. I think you should go back to your material sort of topics from a sector perspective, and then look at indicators that will address those.
Okay, thanks. Maya, how about you? What would you say? Do you think doubts about greenwashing are slowing market growth at the minute? And what examples of greenwashing have you seen in sustainability-linked financing?
Yeah, I don't think that. Certainly there are investors, and we've had, despite our ratings with Robert, I think that there's still investors that are obviously quite cynical about what we do, and what many issuers, especially in industries like ours that actually are big emitters of CO2, for instance. But I do think that we do see companies that are either being advised improperly by their financial advisors, or the company itself, frankly, is trying to get this halo effect of having a green financing without really achieving the underlying kind of real deep value that is supposed to be obtained. And greenwashing comes in a variety of flavors, in my view. I mean, structuring could be part of the greenwashing process. The quality of disclosure could be part of the greenwashing process. The frequency of it, the clarity of it, the auditability of it, I think all of those things are very important elements of either greenwashing or being a mitigant to greenwashing. And also the ambitiousness and the degree that the KPIs that are being committed to do actually impact and contribute to the path of whatever decarbonization, water management, or whatever of that issuer, right? So, one of the things that we're very concerned about, and I say we here just as a participant, one of the folks at the CFO coalition, is we're trying to develop playbooks and roadmaps for issuers around the world by sector, and to actually kind of establish a best practice for the industry. In my case, I'm looking at building materials, real estate, and construction companies, so that we kind of speak the same language, use roughly same standards of KPIs, go through the same process, adhere to kind of the same ambitions in terms of, well below 2%, 2 degree or 1.5 degree scenarios, for instance, which currently doesn't exist for our sector. So I think that, we're trying to play a role of educating issuers as much as possible to bring them through this journey so that they realize that, and in the long term, this is going to be the only way to raise capital, in our view. And so the quicker we get to a better standard, a clearer standard, and a lot of parties have a hand in this. I mean, regulators have a hand in it. Strictness of investors have something to do with it. Rating agencies, have something to do with this. And but I think those are the things that, in my view, are happening right now in the market.
Robert, similar question but slightly different phrasing. What do you think are the obstacles to overcoming greenwashing at the minute in sustainability-linked financing? Or feel free to give us some examples of greenwashing you've seen yourselves.
So I think I think there needs to be a better level of commitment from companies that when they're going down this journey, they really do buy in. As we've seen from Cemex, I think we've seen quite a few examples where it feels like the banker has gone to them and said, if you issue a green bond or an SLB, we can bring down your cost of financing. And they go, okay, great, what's the minimum? What's the minimum we need to do? And we see that quite a lot. There was quite recently a US utility that had a perfectly reasonable use of proceeds project in terms of funding renewables, but just everything about the program in terms of how they put it together, we felt was just a bit below par. So they didn't feel like they needed to have a second party opinion, for example, which is quite an important and sort of best practice seen from European perspective, from European investors. And really, I think there was a feeling that they felt that, it's a 4 times oversubscribed issue anyway. We don't, it's obviously worked. We don't need to do more. And I think that is the wrong mindset, because I think the way that the world is going, as Maher's laid out, is you need to commit to this, because this is what is going to become expected from investors. So I think that will help, I think, as people gradually start to realise that. But also, more standardised structures, the ICMA guidance for best practice that I mentioned, and bluntly, investors just getting more and more used to these products as well. That one thing that we haven't talked about today is the additional strain that understanding and effectively analysing the investments puts on asset managers such as ourselves, where we're moving away from being just analysing pure financial risk to suddenly having to have an opinion, for example, on the efficiency of a clinker of cement, or what the right weight of plastic packaging is for a retailer. These are two of the sort of metrics that have been put out, and that requires an additional technical skill set. So I think that needs to build up there, and I think it's one area where I feel the conference today as well. I feel there's definitely scope for a better interaction between the I don't want to call myself an expert, but the financial experts and the people that know about sustainability, and being able to bring that together to come up with potentially scoring for quality of materiality, these sort of things that will help investors and help achieve better results.
Okay, last question from me, and then I'm going to hand over to audience questions. Had a few more, but I'm just going to try and consolidate it into this question. It seems like social bond issuance has slowed slightly and has maybe been absorbed by sustainability-linked bonds and loans in the past year or so. First of all, I'd just ask, do you agree with that? And then second of all, I would ask, do you think that sustainability-linked financing is kind of good enough, the best instrument to kind of execute a lot of these kind of social problems that social bonds, social loans try to kind of tackle? And to sort of that extent, are sustainability-linked bonds and loans the best instrument to execute a just transition? So I know that was a bit of a mouthful question, so sorry, you can ask me to repeat it, but I'm going to start with Farnam, if that's okay.
I don't agree that sustainability-linked bond issuance has kind of absorbed social bond issuance. I mean, there's a lot of reasons why social bond issuance has slowed post-pandemic. Most of what you saw in that kind of surge of issuance was sovereign or sub-sovereign or multilateral development institutions issuing in social format. And frankly, the sort of pandemic has receded. And that's resulted in them returning back to their sustainable or green issuances. I think whether it is a sustainability-linked format is a good format by which to execute on a just transition strategy. I mean, I'm very excited about the work that's happening, I think, on the investor side around labeling that I'm sure Robert will talk about to better define this, because I think what I've always struggled with is that I don't think that just transition in and of itself is something that you want to execute within a sustainable financing. I think when we looked at this from the ICMA perspective, just transition comes across in the governance of a sustainability-linked instrument. It comes across in the reporting. It comes across in the project selection, because you should have social standards for your environmental projects. So there's a lot of ways in which you can embed thinking around just transition into a sustainability labeled instrument. But whether the label of the instrument should be just transition, I'm personally skeptical on.
Interesting. Sorry. Maya, what would you say?
Yeah, I was wondering if that was an answer there.
Yeah.
No, I mean, I think, at least at Cemex, I mean, we've taken a very holistic view of sustainability, and just transition is a very important element of our strategy. While I don't think, I mean, this is me personally, I don't think that coming up with financings that are for just transition is probably suboptimal. I think what's going to happen as all of us, because many companies, and certainly ourselves, have been doing things in terms of helping communities, educating, training, providing mortgages in some communities. I mean, we have a huge community efforts and outreach effort to communities around our plants, and we have 56 of them around the world, and we have like 1,300 ready-mix plants around the world. So you can imagine how embedded we are in communities. I think what's going to happen as it becomes clear what some of the KPIs for just transition, and they become verifiable, and the impact of the KPIs become clear, I think that there will be an emergence of a subset of KPIs that will be demanded by investors in general to be part of the commitments that companies are making for their overall decarbonization process. I mean, I think that's probably what's likely to happen. I think people do mean well, and I think as soon as that clarity happens, we will start seeing, those KPIs, not many, but we will start seeing those KPIs as a subset of the overall climate action challenge KPIs that are being used for raising capital.
Okay, and Robert, can I just rush you in your answer so we can get to some audience questions, if that's okay?
Yeah, I mean, very quickly, I think from my perspective, if you think of shouldering the burden of a just transition, I definitely think companies have a role to play, but isn't it the responsibility of governments, largely to deal with some of these social issues and potentially, my personal view is that you're probably more likely to see a sovereign just transition instrument first before you see a corporate one. Personal view, but there we go.
Okay. All right. Okay, great. Yes, we've been told that we have to have a very hard stop at 5 o'clock. So I'm going to be a bit mean and say, please don't tell a story, ask a question. So maybe this person at the front here in the white.
Thank you. Thierry Tamlin, Morgan Stanley. Robert, this one's for you. Maher, you mentioned a few times that you won't be able to raise financing unless you come in a sustainable format. So directing to you, Robert, not just as head of responsible investment, but as an investor representative on the table. I think you alluded that you agree with that, but I'm sure there's some structural constraints maybe within the investor community to invest just in a sustainable format. Can you just point to that? And Maher, you mentioned also that investors are asking you for more products, so the way that you would raise financing, but you also touched on derivatives, and I've always been intrigued as to how that achieves sort of real world output. So would love to hear your thoughts on that.
I'll go first. I mean, to clarify my thoughts on it, I think that in 5 years' time, the sustainability profile of an issuer will be core to any investment decision that is made. That doesn't necessarily mean that you have to buy a use of proceeds instrument. As you say, there's only a certain number of projects, and you do need to be able to have sufficient diversification. But I do agree with the concept that the sustainability strategy should be at the core of the investment decision.
And very quickly on the derivatives piece, I mean, in our case, for instance, we used a cross-currency swap to go from dollars to euros, which is part of our financing strategy. It was not a risk reduction; it was a proper capital structuring for the company, and so we felt very important that is an integrated part of the cost of funding, and therefore embedding a sustainably linked up and down. It was a symmetric thing with the syndicate of banks that did that with us. What was totally congruent with our financing strategy and our debt stack being sustainably linked to that extent. So that was the logic of doing it. It was the first one in our market. I don't know. It's quite a unique notion, but that's one of the things that we wanted to send a message that is a market that is interesting, should be interesting. Now, of course, it's not an investor market, it's a bank market, so it's a little different.
Could you please raise your hand if you have a question on José's presentation? I'll come back to other audience questions, but okay, yes, this man in the back with the white shirt.
Hello, my name is Uwe Biermann from Isos Asset Management. I have a question. How do you get access to, best practice KPIs when these will be set by companies who are not relying on, publishing their results because they are family-owned companies or however? And I think in view of the targets, it would be very important to have these best practice KPIs to also define the benefits and penalties you were talking of. Thank you.
That's a question for me or for you, maybe?
So the question is really if you have a data gap around a KPI, how do you deal with that? Is that the question?
The The question is, these figures, they are mostly treated with high secrecy. So if you have companies that are not participating in financing because they have enough own resources, it will be very difficult to get access to these figures.
Yeah, I agree, but would they presumably won't be coming to the market to issue these? I think if you come to the market, disclosure is vital. So it's not to say that we would never invest in those companies, but I think, you know, transparency when it comes to sustainability strategies is important, and we would need to get comfortable as investors that we have a grip on the sustainability strategy. And obviously, if they're not prepared to give data around that, then that does make it harder to invest.
Okay, thank you.
Does anyone have any questions about José's presentation?
I wanted to touch
go
on
on.
that. I mean, I think it's something interesting in the loan market is that it has been traditionally been a private market, so they really don't need to disclose their deals and all these agreements. And what is happening now is that with the sustainability linked structures, they are starting also to disclose not only the sustainability aspect of their business, but also the financial aspect of their business. So I think from the perspective of banks, now that they are also committed, for example, to reduce Scope 3 emissions, like financed emissions, these instruments can be very helpful to improve the transparency of the sustainability aspect, but also the credit risk aspects. That could be something that we could expect in a very near future, as Farnam said.
Okay, any other questions? The woman in the black at the side, that's okay.
Hi, Tessa Walsh from Al-Haffar. Can I just ask about your research? The findings about the impact of the principles, I think, is really interesting. Can you just talk about that a little bit more and what the potential implications are and perhaps how we can address that?
Yeah, I mean, there's what I have seen recently. I mean, the principles were published in 2019 and they have been, there is an update. It happened last year in 2021. And there is like a tension with these loan associations as well with the ICMA that from their perspective, they cannot be very prescriptive in the principles. But at the same time, different stakeholders are demanding for this to be more specific on the recommendations. I think, for example, ICMA is doing something quite interesting, as Robert said. They already, I think 1 month ago, they published a very similar materiality map, the one that I showed. They're using SASB standards, but they're also integrating other frameworks, for example, the TCFD guidelines. And they're offering, I think they're just reaching at this point a sector level, which is not enough. Still, SASB is much more useful because it goes to 77 industries. But I think this is something that will start evolving. I mean, the way we can categorize all these indicators and also with all the progress of ISSB coming in the coming months, I think it will be very useful. So, yeah, I think we're going to start looking at more and more publications around best practices, like the ones of Cemex, for example.
I've been told to stop at 5:05 sharp. So just one last question. I think this woman in the black blazer at the front here.
I have 2 very quick questions.
Okay.
The first one is the process around how KPIs are set. So a company sets its own KPIs. Do you think that maybe someone else should? So an investor, or maybe there's the equivalent of a green bond standard in which particular KPIs are appropriate. And then the second question is around step-up rate. So what might be an appropriate step-up rate if, for instance, all of a company's debt is sustainability linked?
Shall I take the first? Maybe I'll take the first one, right? I mean, I think in our case, again, you need to step up by industry. I mean, so in our case, carbon emissions are critical. And you know, SBTI, for instance, has if your curve that you're adhering to is the well below 2 degree scenario, you have an emission reduction over, you know, from now until 2030, from 2030 to 2050, and then you take a look at your emissions, I mean, it's pretty scientific. This is not something that we are just doing. So I think what's happening is that companies are identifying the key levers. We're then working with SBT, especially if you're committing to targets that are science-based targets, so you're not just reaching out of the air for weird targets, because that's also, that's part of the credibility, part of the greenwashing. And then all of these things are super verified at the end of the day. The level of conversation that takes place between our technical people and SBTI technical people for the diligence process. And then when you go to the capital markets, that's not enough. You need the second party opinion. So then Sustainalytics, in our case, for instance, which is I think it's the largest provider, then comes in and spends another probably 2 or 3 months doing diligence at the technical level. So I think the quality of the KPIs at the end of the day and the rating that you get from SBTI or the second party opinion gives you an idea of how rigorous and how material those targets are, those KPIs are.
Farnam, would you like to answer the second part of the question? You don't have to, probably.
I almost wonder if we should both answer it at the same time and just see whether we come out with the same number, because I'm probably going to come out with a higher number. But do you want to go for it?
I think it's commensurate with the credit risk, right?
Exactly. Yeah. So it depends on the funding rate, right? If it's funding at 500 over, then in terms of credit spread, then 25 basis points is nothing. But if it's funding at 10 over, then 25 basis points is a lot. So. But I mean, I think a general consensus would be for sort of a BBB type company that you'd want to be close to sort of 75 basis points. So quite materially above where it is at the moment. And the interesting thing then would be, if you start to have that, then the analysts are going to have to start pricing that. So you're going to have to start looking at option pricing, etc., to be able to price that additional coupon, which is another interesting piece of work.
5:02. Did the woman in green have a question?
Following on that, given that the standards are not there yet or they are still evolving and everything, so do you face an issue where a person who's institution who's asked for investment, and given the step-up rate is only 25 basis point for now, whatever the industry has decided, that they are already pricing that in, but not really hitting their targets, and then what happens then? Does that ever occur? Or how do HSBC, for example, would monitor that or would control that they are not just ticking the box off the target they've signed up for and priced in the step up, but actually doing it for a long term?
So the market is not mature enough, to be honest, for have seen a lot of issuers actually even come to the target observation date. I think we've seen a handful, and they've all met their targets. I will say that from the conversations that I have with our clients, the reputational risk of missing your target is the bigger concern rather than the financial risk. And so, I appreciate Robert's point that maybe these 25 basis points doesn't bite enough, but I can tell you, we worked with an issuer in the luxury sector who's just missed their interim target, not even their actual target. And there's a headline in Bloomberg saying they've missed an interim target, which wasn't even what they committed to. And it's for a company, that's not a great outcome. So that's really the bigger deterrent.
Can I just add one point on that, which is very important? I mean, I think that we're thinking about it from a bond perspective. I think the reputational risk is not just reputation. It's the bigger risk, which is the equity, your cost of equity capital. Because if you miss those targets, then guess what? BlackRock is going to say, I'm not investing in your equity. And that is much more important than missing it from the bond perspective. That's how we see it, at least. And that's very important.
Okay, time's up. Thank you so much for your attention and your questions, and to our panelists for your insight and your time. If you have any other questions, I'd say bother the panelists on our walk over to the Sheldonian, I believe, for the debate. So I think that should be a good one if anyone knows the directions. Yeah.